Are you self-employed and your tax returns don't tell the whole story? Then don't rely on your tax returns when qualifying for a mortgage. Continue to reap the benefits of tax deductions while still qualifying for the home of your dreams.
With an alternative documentation loan known as the bank statement loan. Stay tuned and find out how it works and how you can benefit from home ownership with the deductions. You're self-employed and you have to wait 2 years of self-employment with 2 years of complete tax returns, whether it's your 1040 with a Schedule C or your 1120, 1120S. Now, you made $150,000 for the year, but in your tax returns, when you filed them, your accountant suggested you that you can claim your mileage and meals and entertainment and expenses and office space. Now that you have all of these deductions on your net profit, you only claim that you made $27,000 so that it can help limit your exposure to the IRS. Well, let me now tell you how it works when you're buying a home as a self-employed business owner with the full documentation loan. You not only must have the 2 year tax returns with all pages, but all of those deductions will be taken against your income, and you can only get credit for your net profit. While there are certain brackets of deductions and expenses that could actually be credited back to you as income, those lines are very far and few in between. And most often than not, the ones that give you the most tax benefits are the ones that you cannot bring back as income. So this limits a lot of self-employed borrowers in today's market that make a pretty good amount of money in their business. But when it comes to buying a mortgage, the tax returns just do not tell the full story. Unfortunately, this goes the same for Fannie Mae, Freddie Mac, FHA, VA, USDA. So all of the full documentation loans for income, they all follow the same guidelines of income documentation. 2 years of self-employment, 2 years of tax returns, and only the net profit can be utilized. Now, Brian is going to go into the explanation of the benefit of the alternative income documentation loan.
Right. Thank you, George. All right. So a couple of similarities and a couple of differences. So with business bank statement documentation method, you still have to have your business for at least 2 years. All right. That's the same. The difference is with business bank statement, you can either take the most recent 12 or the most recent 24 months of your bank statements to show income. So how it's going to be calculated, they're going to take the gross profits out of your bank statements for those 12 or 24 months. All right. And then they're going to average that out on a monthly basis based off of whether it was 12 or 24. All right. So now what they're going to do is they're going to take what's called a business expense ratio to those total deposits. So the standard one for most of the lenders we work with is 50%. However, if that business expense ratio is different, 30%, 40%, your CPA just has to write a letter showing that business expense ratio is different and not 50%. So if you make an average of $20,000 a month in your business bank statements, you're going to be qualifying with $10,000 worth of income after that expense ratio. Unless, say, your CPA comes back and says it's 30%, then you're not going to be hitting at the full 50% business expense ratio. It's going to be off of 30%. All right. I constantly get asked all the time, how much do I have to claim on my taxes in order to qualify for an FHA or conventional loan? All right. So what I want to do in hopes of doing you kind of a breakdown of the difference between an FHA and a conventional loan, and then a business bank statement loan, which does not go off of your tax returns. Right. So I want to dive into this scenario really quick. And again, this is exactly just a scenario. Obviously, your numbers could look a little bit different. Happy to run those numbers for you if you have something more specific. But this scenario, so the borrower owns their own company with gross company earnings of $400,000 a year, but writes off a significant amount of expenses, only showing a taxable income of about $34,000 a year. All right, the borrower wants to deduct nothing on their 2022 tax returns so they can show maximum income for an FHA or conventional loan. All right, so I hear this all the time. How little should I write off to show as much income as possible? All right, so For this scenario specifically, we used a 740 FICO and a purchase price of $400,000. All right, so if you didn't deduct anything off of your taxes at all, and you brought in a gross earning of 400,000, this is kind of on the extreme side, but filing singly with 2022 tax brackets, you would owe the IRS about $114,000. All right. Whereas if you use deductions and reap those benefits, because taxes are set up for, investors and self-employed people to benefit, you can still take advantage of loan programs while still reaping the benefits of tax deductions. All right, so we're going to compare them side by side. FHA 3.5% down, conventional 5% down, and then a business bank statement loan. All right, so with FHA, you'd have a down payment of $14,000. Conventional, the minimum down payment 5% down would be $20,000, and business bank statement, the minimum down payment of 10% or $40,000. All right. So another myth that I hope to bust on this too is people get so hung up on that interest rate. All right. But with everything else factoring in, the higher interest rate makes a lot of sense if you're looking at the big picture. So you've got business bank statement. We use the interest rate of 8.25, conventional 6.5, and FHA 5.875. Now, conventional and FHA both have MI, whereas business bank statement does not. So if you factor all of that in based off of the loan amount and the interest rate and mortgage insurance, if applicable, brings you to a total monthly obligation. Again, taxes and insurance would be the same for all three. So we're just going to focus on principal, interest, and mortgage insurance. Business bank statement, you'd be at $2,705. Conventional, you'd be at $2,494. And FHA, you would be at $2,595 with the respective down payments and interest rates for those. All right. So your difference in payment when you go conventional versus business bank statement, you're going to save about $211 a month going conventional, whereas FHA, you're going to save about $110 a month. All right. So over the life of the loan, you would be saving $75,960 going conventional or $39,600 going FHA. Now, why would it make sense to pay the IRS $114,000 to not even save that over the entire life of the loan? Plus, you would still have, down payment and closing costs you're coming out. So why wouldn't you just put another 5 or 6.5% of equity in your home, pay $100 to $200 more a month, and not have to deal with the amount of income you qualify on your tax returns? George,
this time of the year, because this is where everyone is trying to wrap up their taxes for 22 in hopes of buying a house in 23. And the question is, because I have the flexibility with the write-offs and deductions that I'm entitled to, I may not want to write off a certain thing or deduct a certain thing if it's going to hurt my income for me to buy a house. And oftentimes when you're self-employed, because you don't pay taxes throughout the year, unless you have it set up to come out quarterly, you're trying to set all this up at the end of the year. And the question is slightly backwards, because if you're self-employed, one of the benefits that is exactly the benefits of tax deductions. Based on the example that you gave right here with the FHA 3.5, I actually had a customer myself, which I'm closing now, where with her self-employment and the structure, for her to claim the income that it would require, it was going to cost her $36,000 as far as the payment to the IRS. And she was going to have to do that for 2 years, because income for self-employed is based on 2-year tax returns. You got to understand that it's 2-year tax returns on what you've claimed to the IRS as far as your net profit. So with the bank statement loan, what we're discussing here, you have to be self-employed for 2 years with a verifiable company, but the loan program itself can allow you to do a 12 months or 24 months bank statements. So your income is not going to be based on tax returns, pay stubs, or W-2s, 1099s. They're going to base it on the addition of your deposits. They're going to actually look at what has come into your business or personal bank statements as income. So you have not only less deductions against you, but you don't have to have that excessive payment to the IRS. So you can still take the benefits of being self-employed and also become a homeowner But that scenario right there, it actually opens eyes because $39,600 would have been the life of the loan difference. But if you're going to pay that per year, that means that after the 2 years that you had to pay the IRS that amount of money just so that you can have a usable income to get that FHA loan, you weren't going to get the rest of that money back. So there is the benefit on the payment. If you took what you had to pay to your taxes and you were to divide that by the 12 months, you could never pay back that money with what you're saving. So ironically, because the media, because everything else wants you to be so rate conscious, right? But if you look at what the payment difference would be and what you actually came out of pocket, you actually benefit more remaining with the benefit of your bank statement loan, and you would still, with the difference in payment, never catch up to the savings. There will never really be a savings. The math just shows it. I mean, you're talking about in the life of the loan, $39,000 compared to $36,000 you would have to pony up per year. That means that already by year two, you catch up to the FHA benefit. And I think that the reason why this happens a lot is because a lot of customers when they're looking for home buying opportunities, besides what they see online or when they talk to the realtors, there's loan programs out there that the box banks don't have or offer. They don't know about this. So their solution is on how to get their taxes structured in order to qualify to buy a home. But if you do this, again, there's nothing wrong with claiming what you make. But if you're using the benefit of claiming your expenses and whether it's a loss or a deduction, and you're doing that for a reason, which again, it is given to you as a self-employed person for you to surrender that to buy a house, it really contradicts because you don't need to. You can still become a homeowner and still keep claiming your taxes the way you are. Now, obviously, the difference is, like you said, look at the down payment. We're having the difference between the FHA 3.5, the conventional at 5, and the business bank statement can be as little as 10%, as high as 20, 25 if it's a townhouse or a duplex, etc. But when you consider what the down payment difference is, which will go towards the equity of your home compared to what you would have to pay out of pocket to the IRS to have a lower down payment. What you pay the IRS does not contribute towards the equity of your purchase. However, the bigger down payment, you're paying it to yourself because it does go towards the equity of your home. So it's a dollar for dollar spent, except one of them goes back towards your investment.
I mean, I couldn't agree with you more. This is why I always try to, try to help people look at the big picture, right? Why would you claim and pay 40, $50,000 more to the IRS? You could put that money into down payment, which is ultimately an investment in your own property that you're going to see again later on down the road. So, yeah, great information here. Looking at things from the bigger picture as opposed to just, you know, how can I qualify for an FHA loan? Now, that being said, there are a couple stipulations. Of course, business bank statement is going to be a little bit more FICO restrictive than FHA loans or even conventional loans would be. So there, that does play into effect as well.
So I think one of the key points that we want to make here is that what we're trying to get you to understand is don't miss out on deductions and expenses that you rightfully can claim out of fear that you have to show more income to qualify for a home. We do not get involved with the amendment of taxes because that is between the obviously the self-employed person and their tax preparer or CPA or accountant. When you do go back to amend taxes to change anything, if you change anything to report more income, the IRS will not only now say, well, then now you owe me this, but because of the time lapse, you're also going to have the penalty fees and interest on that amount owed. If you do that, we've had also customers that have agreed with the IRS to enter into a repayment plan so that they can pay that amount owed to the IRS in smaller installments. Um, Ironically, with the full documentation income loan programs, right? When you do that, you must have made 3 on-time payments to the IRS on the payment plan, and you cannot prepay it. which means that not only did you set yourself backwards by having to amend something that you already had filed, and you're going to now immediately and automatically owe the IRS money, but you're also going to owe them with the penalty and fees, but you would have to pay all of that money at once because you can't enter the repayment payment plan and still go in the market home shopping effective immediately, right? So you would have to take care of that not only effective immediately, but then when you do this year's taxes and you file that higher income, you're also going to end up with taxes due, which you would have to also pay in a lump sum to be able to get your 2 years with no amount due to the IRS. So when you really think about it, the down payment variance between the business bank statements and a conventional or an FHA, if you really consider what you would be paying in IRS for taxes due for those 2 years, you may offset that with the down payment.
I really understood how that made sense. So you're going to amend your taxes from the previous year, get onto a 12-month repayment plan where you've got to pay what you owe them in 12-month installments. You have to make at least 3 of those payments before you can actually qualify for that mortgage. But we were initially dealing with an income issue. So we amend taxes to show more income, but now we have monthly payments that are hurting our DTI, thus resulting in another income issue. Doesn't make very much sense to me.
Right. Ultimately, you end up trying to outrun your expenses because you're trying to claim more income to qualify. Therefore, you're going to amend your taxes to show more income. But now, because you showed more income, you owe money. But now, because because you owe this money, you're going to go in a payment plan. But the payment plan, they're going to divide it by the remaining months, like you said. So it depends on how much you owe by the months due to the next tax filing season. You got to add that to your expense for the debt to income ratio. So now you're going to find yourself, well, I need more income so that I can have enough to qualify after the one that I just claimed. When ultimately, a good consultation with a loan officer that offers a bank statement loan program can go ahead and based on the numbers. Because again, look, not every income bracket will better be served by a bank statement loan, right? I mean, if you're really making 35, 36 and you're claiming such, I mean, and it works for you, it works for you. But we're talking about, we have a lot of clients that make over 6 figures. And when we see their net income, they make less than a door greeter at Walmart, right? So now we're having to help them because obviously the person making 6 figures, they want to buy a house within their means. But their tax returns just do not tell the story and would actually cause them to be denied because again, according to their taxes, they don't even make enough to own a home. So with these programs, not only can we find the income, but a lot of the objections we're finding is because the down payment is too high. But in order to make this income structure work, you're actually going to claim a number high enough to basically equivalently give the same down payment to the IRS as a tax payment, and you will be surrendering your actual benefits of being a self-employed individual because you're trying to force a square peg in a round hole. And there are programs out there that are structured to help you where you can have, what is the saying, have your cake and eat it too.
Yep. All right, everybody, that's the ins and outs on business bank statement. If you have any questions, give us a call, shoot us an email, let us know how we can help. And yeah, everybody have an excellent week.
Everybody have a good one. This has been George and Brian with Simple Lending Mortgage.